Sam sat in his car outside the office garage, engine off, hands on the steering wheel, and he could feel it. Something in the market had shifted. Not in a headline way, not in a breaking news way. It was quieter than that. It was the mood, the confidence. The way people were suddenly acting like risk didn't exist. A few months earlier, Sam's coworkers had laughed at anyone who hesitated. Now those same people were whispering about what could go wrong. Sam didn't know whether to feel relieved or terrified, because he couldn't tell if this was the beginning of trouble or just another fake out. If you have ever looked at the market and thought, I can't tell if I'm late or early, you're not alone. That confusion is the trap. That tension is exactly what Mastering the Market Cycle by Howard Marks is about. Marks doesn't promise you a magic signal that tells you the top or the bottom, how cycles really work, why they repeat, how psychology pushes them to extremes, and how you can position yourself so the odds tilt your way instead of against you. This covers every major chapter, so by the end, you'll have the full picture. Sam's first mistake was the same one most smart people make. He assumed the market is mostly a math problem. If the data looks good, the future should behave. If the company is strong, the price should reflect it. If the economy is growing, risk should be manageable. But cycles don't care about what should happen. And humans are not stable. Humans swing. Marx starts by forcing a simple question. What is a cycle? A cycle is a repeating pattern of ups and downs. It is not a straight line. It is not a one-time event. It is a rhythm. Cycles show up everywhere, not just in markets. They show up in the economy, in company profits, in credit, in real estate, and in the psychology of investors. Think of it like breathing. You inhale, you exhale. You don't inhale forever. If you tried, you'd pass out. Markets are the same. Expansion creates the conditions for its own slowdown, and fear creates the conditions for recovery. That's the weird loop most people ignore. Now this next part matters, because it stops you from chasing the wrong goal. Marx says you don't master the market cycle by predicting the future perfectly, and by recognizing where you stand in the current rhythm. Sam heard that and immediately wanted a checklist. He wanted a dashboard, he wanted a neat answer, so he did what he always did. He opened his investing app early in the morning. He looked at charts, he looked at earnings, he looked at hot takes. Then he texted his friend Leo, who always seemed calm during chaos. Sam said, "How do you know when a cycle is changing?" Leo replied, "I don't know, I watch people. That's when I start acting like something can." That annoyed Sam. Watching people sounded vague. It sounded soft. It sounded like guessing. But Marx is clear. The biggest driver of cycles isn't just numbers, it's behavior. And behavior follows patterns. So Marx asked another question, why study cycles at all? Because ignoring cycles is not neutral. It is a bet. If you pretend cycles don't matter, you will eventually find yourself taking the wrong risk at the wrong time. And most cautious when you should be brave. That's the tragedy of cycles. They don't punish ignorance immediately, they reward it first. Then they collect the bill later. It's like touching a hot pan that heats up slowly. You don't feel pain at first. You keep your hand there, you get comfortable, you get burned. Sam had lived that exact experience. He remembered a year when every dip bounced. He started buying dips automatically because it felt like a law of physics. He took bigger positions because the market kept forgiving him. He even started thinking his intuition was improving. Then one day, a dip didn't bounce. It fell again and again. Sam watched his screen and felt his throat tighten. He told himself it was fine. It had always been fine. But the market wasn't interested in his recent memories. The market had moved on. Marx then goes deeper. He explains the nature of cycles. Cycles exist because of excesses. When things go well, people do more of what worked. They expand, they borrow, they build, they take risk. But it also creates vulnerability. Eventually, the system gets stretched. Then, any disappointment, even a small one, can flip the mood. Cycles are not just up and down in outcomes. They are up and down in attitudes. People don't just earn more and then earn less. People feel optimistic and then feel pessimistic. People feel safe and then feel scared. That emotional swing changes decisions. Decisions change outcomes. Outcomes reinforce emotions. That's how cycles feed themselves. Think of it like a crowd at a concert. When everyone is jumping and screaming, you feel pulled into it. You shout louder than you planned. You move closer than you planned. Then someone yells that something is wrong, and the exact same crowd energy becomes panic. Same people, same building, different direction. Marx also talks about the regularity of cycles. Cycles are not scheduled. They don't arrive on your calendar, but they are regular in the sense that human nature is regular. People get excited. People get fearful. People forget pain over time. People extrapolate recent trends. Then reality interrupts. So stop asking for a timetable. Ask for a temperature reading. Are people cautious or carefree? Are lenders strict or loose? Are investors demanding bargains or paying any price? Are companies disciplined or reckless or certainty? If you want to test yourself, do this. Think about the last time you heard someone say, "It can't go down." What did that sentence really mean? Now the map gets more concrete. Marx walks through the economic cycle. The economy expands and contracts. In expansions, employment rises, spending rises, production rises, and optimism rises. Businesses invest more. Consumers borrow more. Everything feels possible. But expansions often plant the seeds of the next slowdown. Companies build too much capacity. They hire too aggressively. And they assume demand will keep growing. Eventually, supply catches up, then passes demand. Margins get pressured. Layoffs begin. Spending slows. The mood turns. Sam's brain wanted to argue here. He wanted to say, but what if this time is different? This time is different is one of the most dangerous sentences in markets. Not because nothing ever changes, but because it's usually spoken at the exact moment people are least willing to respect risk. And the economy does not always drive markets in a neat one-way line. Markets can lead, credit can lead both. Psychology can pull the system forward or backward before the data confirms anything. Government involvement with the economic cycle. Governments and central banks try to smooth cycles. They influence interest rates. They influence liquidity. They change incentives. Sometimes they extend expansions. Sometimes they create bigger imbalances. The point is not to treat government action like a guarantee. It is a factor, not a shield. Sam learned that the hard way during a period when everyone repeated the same comforting line. They said there was a safety net under everything. Sam started buying riskier assets because he thought the floor was protected. Then a surprise hit. The floor wasn't where he imagined. The price moved faster than his confidence could keep up. And that's when believing in a safety net changes how high people climb. Next is the cycle in profits. And this is where a lot of investing mistakes are born. Company profits are cyclical. Even great businesses can have cyclical earnings. Average businesses can look amazing at the peak. At the top of a boom, margins often look strong. The future looks strong. That's exactly when people overpay. Because they assume current profits represent normal profits. But cycles mean profits revert. Competition increases. Costs rise. Demand slows. Then earnings disappoint. Stocks fall. Suddenly, the great company doesn't feel great anymore. Not because it became bad overnight, but because people bought the peak as if it were permanent. It's like judging a runner by watching him sprint downhill with the wind at his back. He looks unstoppable. Then the terrain changes and you realize you were watching conditions, not just skill. Sam had done that too. He bought a company after reading glowing commentary about how the business has never been stronger. When earnings slowed, Sam felt betrayed. He blamed management, he blamed the market, he blamed himself. You were watching a cycle. You just didn't label it. The pendulum of investor psychology. This is the swing between optimism and pessimism, greed and fear, risk-seeking and risk avoidance. Marx says investors don't stay in the middle. They overshoot, they go too far. When times are good, people don't just become optimistic, they become euphoric. They start believing the future is certain. They stop demanding safety. They accept weak deals because they fear missing out. When times are bad, people don't just become cautious, they become depressed. They start believing nothing will ever improve. They refuse risk even when bargains are everywhere. They sell low because it feels like relief. And here's why this matters. It changes pricing. When optimism is extreme, prices rise, and future returns usually fall because you already paid for the good news. When pessimism is extreme, prices fall, and future returns often rise because you got paid to take discomfort. Sam ran a small experiment. For a month, he wrote down the mood he saw online. Not earnings, not charts, mood words. Words like unstoppable, easy, guaranteed, dead, hopeless, rigged. After a couple of weeks, and he saw the pattern clearly. The most confident language showed up after long runs up. The most hopeless language showed up after sharp declines. It sounded obvious, but seeing it in his own handwriting made it real. Sam showed the notebook to his sister Maya, who didn't invest. She flipped through it and said, "So you're telling me people get excited after they win and scared after they lose?" Because that's exactly it. And that's why the pendulum matters. Markets don't just reflect reality. They reflect emotion layered on top of reality. Marx connects that pendulum to the cycle in attitudes toward risk. Risk is not stable in people's minds. At the bottom of a cycle, risk feels enormous. People demand high returns to take any risk. They want safety. They want guarantees that do not exist. At the top of a cycle, risk feels tiny. People accept low returns. They buy weak deals. They treat risk like a formality. Marx makes a point that changes how you see everything. The perception of risk is often greatest when risk is actually lower, and the perception of risk is often lowest when risk is actually higher. As a cycle pattern, that is brutal. It means the crowd's confidence is frequently backwards. Think of it like driving in fog. When the fog is thick, you slow down and pay attention. When the fog clears, you relax. Markets flip that behavior. When the fog clears, people speed up. When the fog arrives, they slam the brakes. Often too late. Sam felt this in his own body. During a quiet bull run, he took risks that would have made his earlier self nervous. He bought things he did not fully understand because everyone else was doing it. He accepted thin returns because the recent past felt safe. Then a downturn arrived, and suddenly he wanted to sell everything, even the strong assets he had bought at good prices. Marx wants you to see that your feelings about risk are a cycle indicator. Your comfort might be a warning. Your fear might be an opportunity. The credit cycle. Credit is the amplifier. When credit is easy, money flows. Businesses expand, consumers spend, asset prices rise, risk is underpriced. Deals get done that never should have been done. When credit tightens, projects stop, defaults rise, liquidity disappears, prices fall, fear spreads. Even good assets can get tossed because people need cash. Marx focuses on lenders because lenders set the terms. When lenders are disciplined, they demand strong protections and adequate yields. When lenders are loose, they compete with each other to lend, which means they weaken protections and accept lower yields. That shift is not a detail. It changes the system's stability. And the credit cycle can turn without a dramatic headline. It can turn because lenders slowly realize they have been too generous. Or because losses show up in one corner and lenders get spooked everywhere. Or because the cost of money rises and old deals stop working. Sam noticed a version of this in normal life. He tried to refinance a loan, expecting it to be simple because his income was steady. The bank officer told him the rules had tightened. Sam asked why. The officer shrugged and said, "We're just being more careful right now." That sentence stayed with Sam. It was calm, it was ordinary, but it was a credit cycle sentence. But it meant the mood had shifted in the lending world. And if lenders were being more careful with him, they were being more careful with everyone. The distressed debt cycle. Distress happens when borrowers cannot meet obligations. It creates forced selling. It creates panic. It creates complexity. But it can also create opportunity for investors who can do the work, keep emotions steady, and demand strong returns. Marx explains that distressed opportunities show up after credit was too easy. Easy money funds, weak businesses. Weak businesses survive longer than they should. Then conditions tighten and the weak businesses collapse. That's when distress spreads. For Sam, this was a mindset shift. He had always assumed the best opportunities show up when everything looks bright. Marx flips it. The best opportunities often show up when headlines look ugly, because that's when prices disconnect from long-term reality. It's like a clearance aisle after a storm. The store is not selling cheap because the product suddenly became worthless. The store is selling cheap because they need to restore order. In markets, forced selling is that storm. But Marx is careful. Distress is not a free lunch. It demands skill, discipline, patience, and humility. You can be early and get punished. Sam once tried to buy the fear with a company that looked cheap. He didn't understand the debt, he didn't read the filings, he just saw a low price and a scary headline and thought he was being brave. It wasn't bravery. It was laziness dressed up as courage. The position dropped further and Sam felt ashamed. He told himself he would never touch anything complicated again. The lesson is not never. The lesson is know what you're doing. If you cannot do the work, you do not get paid for the complexity. You just absorb it. Next, Marx turns to the real estate cycle, which most people feel personally. Real estate cycles are shaped by supply and demand, i.e., credit conditions and psychology. When prices rise, builders build, new supply arrives later. People buy because they expect prices to keep rising. Lending gets easier. That pushes prices higher. Then supply catches up. Affordability worsens, demand cools, credit tightens, prices stall or fall. Suddenly, the same asset that felt like a guaranteed win feels like a burden. Real estate is especially cyclical because it is slow to adjust. Construction takes time, policies take time. People take time to admit they were wrong. That lag creates overshoot. Sam and his partner, Lena, debated buying a condo during a period when everyone said prices only go up. Sam felt pressure because friends acted like homeownership was a test of adulthood. Lena asked a simple question. If prices stopped rising for years, would we still want this place? Sam didn't answer immediately because he realized he had been relying on appreciation to justify the decision. He had been thinking like a cycle chaser, not like an owner. That question saved them from stretching too far. It didn't make them anti-real estate. It made them realistic. Now Marx does something powerful, the market cycle. The market is where these cycles interact. The economy influences profits. Profits influence sentiment. Sentiment influences risk appetite. Risk appetite influences credit. Credit influences asset prices. Asset prices influence confidence. Confidence influences behavior. Behavior feeds back into the economy. So the market cycle is not one wave. It is many waves overlapping. That is why simplistic timing advice fails. It assumes one wave. Marx wants you to respect the overlap. So what does mastery actually mean? It means you observe, you assess, you act with calibration. Marx says you try to figure out where you stand. Not with certainty, but with probability. Then you position yourself to improve your odds. And now it gets practical. Marx explains how to cope with market cycles. First, you accept cycles are inevitable. Trying to eliminate them is like trying to eliminate winter. You can complain or you can prepare. Second, you build behavior that does not collapse when mood shifts. That means you have a process, you have standards, you have a way of deciding that isn't purely emotional. Third, you stop expecting perfection. You will not buy the exact bottom. You will not sell the exact top. If you wait for certainty, you will act late. With discipline, Sam needed that message. He had been waiting for a sign that felt undeniable. When he didn't get it, he froze. He watched opportunities pass because he wanted to feel sure. You don't get sure, you get thoughtful. Think of it like surfing. You don't control the ocean. You learn to read waves, choose your moment, and balance. You still get wiped out sometimes, but you stop paddling straight into the biggest wave just because everyone else is cheering. Cycle positioning. Positioning means adjusting how aggressive or defensive you are based on the environment. When markets are euphoric, credit is loose and prices are high. Your job is not to prove you're brave by taking more risk. Your job is to survive. You might hold more cash. You might demand higher quality. You might reduce leverage. You might accept looking boring while others brag. When markets are fearful, credit is tight, and prices are low, your job is not to hide. Your job is to selectively lean in. You become more open to risk when you are being paid for it. This is not a call to constantly trade. It is a call to be aware. Sam tried positioning in a simple way. He created 3 modes for himself: defensive, neutral, and opportunistic. He didn't tie them to one indicator. He tied them to the overall environment. When he sensed extreme optimism, he shifted toward defensive behavior. He tightened standards. He reduced new risk. He focused on resilience. When he sensed extreme pessimism, he shifted toward opportunistic behavior. He looked for quality selling at discounts. He sized carefully. He tried to buy with patience instead of urgency. And here's the surprise. Defensive mode felt uncomfortable because he feared missing out. Opportunistic mode felt uncomfortable because he feared being wrong. Because positioning that works usually feels psychologically inconvenient. If it feels easy, it is probably crowded. Limits on coping. There are limits to how well you can time or position. Cycles can go further than you expect. Extremes can last longer than you expect. Markets can stay irrational longer than your patience. So Marx tells you to be humble. Use probabilities, not certainty. Avoid leverage that forces selling. Avoid concentration that can break you. Make sure you can survive being early. Sam learned this with a frustrating lesson. He correctly sensed optimism was extreme and positioned defensively. Then the market kept rising for a long time. Sam felt stupid, just to stop feeling left out. Instead, he set a rule. If he positioned defensively, he would not judge it by what happened in the next week. He would judge it by whether it protected him during the full downturn. That rule saved him from emotional whiplash. It kept him aligned with Marx's idea. Positioning is not about looking smart today, it is about being intact tomorrow. Eyeing the cycle in success. Success is cyclical too. After a streak of good results, you start believing it came from skill alone. You take bigger risks, you loosen standards, you become more confident than your evidence deserves. Then the environment shifts. Old behaviors stop working. If you keep doubling down, the cycle punishes you. Winning can make you reckless. It's like playing a game on easy mode and thinking you mastered it. Then the difficulty changes and you realize you were playing the settings, not the challenge. Sam felt this. After a strong year, he started giving advice to friends with confidence. Then a rough period arrived, and Sam didn't want to talk about investing at all. He felt exposed. Learn the difference between skill and environment. Stay grounded when the environment flatters you. Next, the future of cycles. The details will change. Technology changes, policies change, players change. Human behavior, incentives, and the tendency to overshoot. So cycles will remain. That means you shouldn't build a plan that depends on cycles ending. And asks one question. When they return, will you be surprised or prepared? Finally, Marx ends with the essence of cycles. The essence is not prediction. It is awareness plus behavior. It is noticing extremes. It is resisting the crowd's certainty. It is demanding a margin of safety when things feel easy. It is being willing to buy when things feel uncomfortable. And acting anyway with discipline. Sam wanted a simple takeaway he could repeat when his emotions got loud, so he wrote a sentence on a sticky note and put it on his monitor. He didn't make it fancy. He made it usable. When things feel easy, be careful. And when things feel scary, be curious. That note didn't make him perfect, but it made him steadier. Steadier is an edge. Now stay with me because the difference between understanding and using this is where most people slip. You can agree with everything and still behave like the crowd. That's why you need actions you can actually take. Here are 4 things you can start doing right now based on what we just covered. First, build your own cycle dashboard, but keep it human, not complicated. Once a week, write down the mood you see in investors, headlines, and conversations. Use simple words like calm, cocky, anxious, desperate. Then write down what people are doing with risk. Are they demanding safety or ignoring it? The goal is not to be scientific. The goal is to stop being unconscious. When you track the temperature, you notice shifts earlier and you stop treating today's mood as permanent. Second, practice position sizing for humility. Never take a position so large that it forces emotional decisions. If you cannot sleep because of one position, that is information. Your sizing is too aggressive for your nervous system. Marx's whole framework depends on surviving the cycle. If your positions can break you, you cannot benefit from being right later. Your first job is staying in the game. Third, rehearse your behavior before the cycle turns. Decide in advance what you will do in euphoria and what you will do in fear. When things feel amazing, you tighten standards, reduce leverage, and remember that low future returns hide inside high prices. When things feel awful, you slow down, research deeper, and look for quality being sold by people who need to sell. You are not scripting exact trades, so you don't improvise under stress. Fourth, separate good news from good price. A company can be wonderful and still be a bad investment if the price already assumes perfection. A situation can be scary and still be a great investment if the price already assumes disaster. Train yourself to ask a simple question whenever you feel pulled by a story. What is already priced in? That question is how you avoid paying too much at the top and selling too cheap at the bottom. It is how you stop confusing emotion with information. If you do only these 4 things, you will start to feel the market cycle earlier, and you will react less like a passenger and more like a driver, even when the road gets rough. Sam looked at his sticky note again, then closed his app for the night. Not because he didn't care, but because he finally understood what mattered. Cycles will come. They always do. The only real question is whether you'll be surprised by them or ready. That's it for this video. I hope it was useful and gave you something real to think about. Thanks for watching and have a great day.